Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Our show today is brought to you by the C5 Global Summit. This is the C5 CCIM Global Summit, and this happens every year. And yes, it is global. It's an excellent event. I've been there almost every year, I think, since it's happened. This year, it's in Chicago. So come join us in Chicago, September 16th to September 18th. I'll be speaking twice. I'll be on a panel about the office market in the U.S., and then I'll also be speaking on another stage about current opportunities and where we are in the cycle today. So learn more at c5summit.realestate, and I hope to see you there. Well, today, let's talk about commercial real estate, and let's talk about REITs. You know, some people are in REITs. They're doing up REITs when they sell a property and they're going into some REITs, or they're just investing in REITs institutionally or privately. And so what's going on with REITs? Maybe you work with REITs as a broker or an attorney. Let's get an idea of what's going on with REITs and how they're looking at the market. Please welcome my guest. It's Ed Pierzak. Ed is Senior VP of Research with NAREIT. Ed, good to see you again.
Likewise, great to be on.
Yeah, thank you. And first of all, it seems like the commercial real estate market's been, I'd just say, in a changing state here for several years. This year's kind of been up and down. First of all, just how are REITs really performing right now as we're just at the start here of September 2025? What are you seeing?
Well, you know, I think as we kind of started the year, we really thought that this would be a year that REIT performance would take off. We thought that the public and private market divergence in valuations would close. But then, then we had some changes. You know, we were on a little bit of a roller coaster ride, and, we had concerns over higher interest rates. We had some new trade policies as well. But interestingly enough, like kind of when we got to mid-year, it really felt as if we were pretty much at the same place that we were at the beginning of the year. You know, and I do think that there's an optimism. We put out our REIT industry tracker. The most recent version's just been out for about a week or so. And we take a look at both operational performance and balance sheet structure of REITs. And what you find is that operational performance, certainly if you take a look at NOI and same-store NOI, it's been quite solid. In fact, keeping pace with inflation. And then when you take a look at REIT balance sheets, low leverage rates, longer term fixed rate and unsecured debt. So they're really REITs are really in a great space. Not only to have some flexibility through some challenging environments in terms of operations, but they're ready for acquisition opportunities. So as we start to see the transaction market kind of come to life, we know that REITs are ready to go.
Yeah. And you have another report I think is very interesting. I want our listeners and viewers to hear about the active manager tracker. Tell them about that.
Yeah, so the active manager tracker has been something that we've been doing now for it's probably almost a couple of years, and the report's interesting because what it does is it follows the 20 or so largest active REIT investors. So these are dedicated REIT investors, and it offers a little bit of insight as to where they're placing their bets. So we see where they're making changes, we see where they're overweight, where they're underweight. And that report just for the second quarter of this year just came out as well. And we started to see some changes there. So kind of leading the pack, both in terms of the allocation and the overweight, was telecom. So this is really cell phone towers. And that's kind of notable because traditionally we saw residential as being kind of the heavier weight. But in residential still has an overweight. It's at about 9%. Other areas with overweights include healthcare and data centers. But I think one of the other interesting things that's happened is if you take a look at office, and maybe to the surprise of some people, office tends to have a very low weight in the index overall. It's just at about 4%. But you didn't have to go back too far where most active REIT managers, or at least on average, they were only had positions in about half of that index weight. But over the last 2 quarters, we've seen that increase. And today, in fact, office is currently standing at 100% of its index weight. So some movement back into office these days.
Yeah, it's interesting to hear what the very smartest investors in real estate and the REIT market are doing there, because I've been preaching on my show that the office market's going to turn around a lot faster than people think, and there we go. Yeah, the experts seem to, or a lot of them seem to think the same thing, and part of the reasons I believe that's going to happen is because of the lack of new supply. And then some buildings being torn down, some buildings being converted. So in markets where you have some general growth, just the supply and demand is going to create some positive changes, isn't it?
Oh, absolutely. And also I think it's important to note, particularly for something like office, there's really, kind of a little bit more of a nuanced story there. Assets that are really kind of viewed as high quality, high amenitized, well located, kind of best in market assets, they actually have been doing pretty well versus some of their counterparts. So, when you look at a little bit of this bifurcation, and also when you take a look at REIT portfolios, they really tend to focus on those higher quality, well amenitized assets. So, not surprising that after valuations have dropped, that people are looking and seeing an opportunity there.
Yeah, well, it's a good point. I mean, and you look at if there's less buyers in the market, if there's some lenders out of the lending on office, and then with higher interest rates, a lot of buyers of these office deals are getting in at better bases. And if you consider real estate a long-term hold, which most people do, what a great time to be buying. I've got some beautiful single-tenant office buildings in southeast cities with 100% occupied by high credit tenants with long leases with histories in the building at an 8 cap. And these buildings would have been 6 caps, in 2021 and sold immediately. So I think it's a great time for a lot of folks to get into office. And while we're talking about kind of supply and demand and rates, let's talk about that related to REITs. What do you see for historically performance-wise for REITs in periods where interest rates were rising rapidly or were maybe being reduced, going down?
Yeah, no. So, it's interesting. We spend a lot of time meeting with investors. A lot of them are institutional investors as well as consultants. And particularly about, I'd say it was really around the first quarter of the year, we had a lot of concern about interest rates. So, in fact, we did several commentaries. They're all available on our website. And we looked at different aspects, and one of them was, well, what about high rates? So we think about the levels, and so what we did was we took a look at a history going back to the early '90s, and we kind of divvied up that time into 3 buckets: periods of low, mid, and high interest rates. And the good news for real estate was that, across both public and private real estate, that they had positive returns across all those environments. So real estate can perform well in a variety of interest rate environments. I think one of the interesting elements, though, was in each one of those environments, we found that REITs outperformed. Just as we took a look at levels, we had some investors say, "Hey, we're not worried about the levels; we're worried about the changes." And with those changes, we did a different type of analysis. But ultimately, what we found was that in both rising and falling interest rate environments, that REITs posted positive returns roughly a little more than 75% of the time. One of the other elements that kind of came out of it was that what potentially is a recipe for poor REIT performance was if we were in a falling interest rate environment and also had a weak economic environment. And we had kind of defined that as annual growth below 1%. And so the good news is, as we kind of look forward, we're not in that type of environment today. So again, very positive on REIT performance. And then kind of lastly, one of the things that is kind of popped up is that REITs have been really in kind of this inverse relationship, or had this kind of trading policy that as we saw the 10-year Treasury go down, REIT total performance went up, and vice versa. And we had a number of investors say, well, is this a forever thing? And so as we kind of dug into that, what we found is, in fact, it isn't. And we find that that inverse relationship has occurred about half the time since 2000, and the other half was a positive relationship. And one of the things that drives that a bit is sentiment. So if there's a more, I guess, kind of pessimistic outlook on the economy, we find that the inverse relationship tends to hold. If it's more optimistic, there's a positive relationship. And although we still have the negative relationship, we are at a kind of an interesting time, because when we take a look at kind of the term spread, which is kind of an indicator of, do we have a pessimistic or optimistic outlook, we're at zero. So we're kind of at an inflection point, and we'll have to see where we go.
Yeah. Well, it's interesting when I look at the 10-year Treasury, and I figure, all right, well, that's a safe return, but inflation, really pecks at that one. And if you're looking at REITs, well, maybe they have the benefit of inflation, helping their rents and NOI go up potentially, and values of their property and replacement costs going up. And how much are REITs thinking about, and the valuation of REITs measured around supply and demand? Because we've had a tremendous amount of supply when interest rates were so low, and now those have been pretty much delivered, and new supply has really dropped off in some markets in a pretty big way. Could that be impactful on the REIT performance?
Yeah, well, obviously, supply and demand is absolutely critical to REIT performance. Mm-hmm. I think the good news is, again, when we take a look at REIT operations, they've been doing quite well, keeping pace with inflation. But also, I think that there's kind of a few other things to note when we think about REITs. In fact, when we take a look at their acquisition and disposition activity, they've been net acquirers kind of throughout the cycle. But as markets get a little more challenged, they pull back on their acquisitions, and as they improve, they kind of increase. So in many ways, REITs are very much capital allocators, and they're not dependent on the fundraising cycle like a lot of private real estate investors are. So they can really kind of stop their activity, and are not forced to maybe put dollars to work in a more challenging environment. But REITs have exercised a lot of discipline, and again, they're traditionally best in class operators. So they're really focused on those operations.
Yeah. Well, Ed, what else would you share with our audience to think about related to REITs performance, and the commercial real estate market moving forward?
Well, I think the big thing is, we're optimistic on the outlook of REITs. One of the things that we kind of touched on here was the divergence in the valuations between public and private markets, and that divergence, continues today. I think that as that gap closes, number one, with that divergence, that makes REITs very attractively priced. As that gap closes, what we'll see is that we will see some REIT outperformance. So I think ultimately REITs can be a great tactical and strategic part of a traditional real estate portfolio.
Yeah, and I agree, and I think it's a great time for buyers to acquire properties and REITs. One of our REIT clients told me yesterday that they're looking to spend about $1 billion in their space, and they are acquiring. And if you're a long-term investor like all of us, like most all of us in commercial real estate, definitely REITs. Time to buy is when no one else is buying, but and new supply is dwindling down. Ed, what would you leave our audience to think about?
Well, I would say that as you think about real estate, definitely think about how REITs can fit in your portfolio. They have a tremendous menu of options that go well outside the traditional four property types that really reflect the modern economy today. And at today's pricing, a great buy.
Yeah, awesome. Well, Ed, thanks for joining us. We appreciate you being on the show.
Thanks. Take care.
All right. And thank you, listeners and viewers. And if you'd like more from Ed and NAREIT, their website is NAREIT.com. And I think also just REIT.com. They've got some great information there. So, and look, if you are going to be in Chicago at the C5 CCIM Summit, please look me up. I'll be there speaking. It's a great event. Can't wait to get to Chicago. Hopefully, I don't think it's near as bad crime-wise as our president says, but we'll see. I'll let you know. Well, thanks for joining us. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. For more podcasts and videos, subscribe and visit CREshow.com.